Hello and welcome to our 2021 Halftime Market Insights video, in which we seek to explain what has happened during the first half of the year, as well as give listeners themes and issues to watch for the remainder of 2021. We will follow the normal agenda that we do for this video series. We will start with an overview of the market and discuss the U.S. economy. We will then move to the traditional asset classes of fixed income, U.S. equities, and non-U.S. equities. Then we will finish with the alternatives section, which consists of hedge funds, real estate, infrastructure, private equity, and private credit. My name is Greg Leonberger, Director of Research here at Marquette Associates, and I will cover the overview section, which sets the stage for each specific asset class discussion that will follow. Shown here is a matrix of asset class returns dating back to 2012, as well as the 5-year and 10-year annualized returns. The most important takeaway from this page is that it's important to be diversified no matter what is leading in any specific year, as the leader across asset classes in each year can change, and there is not a consistent winner every year. For this year, the leaders are commodities and equities through the first half of 2021. We will carefully be watching not only their performance, but performance of all asset classes. Again, it is important to be diversified as the leader across this matrix changes most years. If we look across the markets, what are some main themes we've seen in the second quarter, and what are we watching for the remainder of the year? You also hear more specifics about each one of these in the respective asset class sections. Broadly speaking, global growth has started to normalize coming out of the pandemic, and most countries will resume their pre-pandemic growth levels by sometime in 2022. We did see interest rates fall in the second quarter, which impacted both fixed income and equities. Again, you will hear more about each one of these in the respective sections. Equities did rise, but we saw a change in leadership. Whereas value stocks have led for most of 2021, growth stocks outperformed value stocks in 2021 for June. Inflation rises, but we don't think inflation is a long-term concern and rather a product of economic recovery and some transient forces which are not long-term in nature. Earnings growth for equity markets are expected to be strong, and volatility has been muted. However, it is not out of the question to see a correction for equity markets sometime in the second half of the year. And lastly, we are watching the Delta variant, as some healthcare experts are already very worried about the impact of the Delta variant in the fall and winter, and what that could do from a healthcare perspective, and then by extension, the impact on economic growth and financial markets. More specifically for the U.S. economy, what are some of the things we are watching? One consistent item we've talked about really since last year is vaccinations and the pace of vaccinations. The good news is that COVID vaccinations in the United States is approaching 50%. About 70% is required for herd immunity, and that is not expected to happen until later this year. 1Q GDP grew at 2.1%. That's a positive in the fact that it is a positive number representing economic growth, but the best is yet to come, and we think economic growth will strengthen as the year goes on. The Fed continues to maintain its commitment to low interest rates. There is some debate right now about when the first rate hike will happen, whether that is late 2022 or sometime in 2023 is still up for debate and bears watching very carefully. I already mentioned inflation. Inflation has been high the last couple of months, but we don't think this is long-term in nature. June employment was 5.9%, and one of the dynamics of the unemployment picture right now is that the labor force has not returned in full to pre-pandemic levels. When that happens, we think the labor market will be even more healthy. Overall, sentiment is positive, but we are carefully watching the Delta variant and, of course, monitoring equity market volatility as the rest of the year plays out.
Hi, I'm Ben Moore, Director of Fixed Income and Managing Partner at Marquette. I'll be walking us through our fixed income outlook. The second quarter was characterized by falling interest rates as the 10-year U.S. Treasury yield declined from 1.74% to 1.45% in the quarter, with the vaccination rate slowing and the Fed talking of liftoff, but committed to maintaining asset purchases and zero rates. Meanwhile, the dot plot projection rose from 0 basis points to 50 basis points in hikes by 2023. Despite the global easing of lockdowns, global central banks continue to signal sustained loose policies. The Fed also announced the sale of $13.7 billion in U.S. corporate bonds that it bought last year with its backstop facilities, a small amount relative to the $11 trillion plus U.S. corporate bond market. Inflation soared while break-evens continued projecting normalizing in 2 years. Break-evens are the difference between treasury rates and TIPS rates and show the market's projections of future average annual inflation rates. Headline CPI rose 5% year-over-year in May, a jump from April's 4.2% year-over-year. Core PCE rose 3.4% year-over-year in May, a jump from April's 3.1% year-over-year. However, we are seeing pork, corn, lumber, cotton, and copper prices start to revert downwards and perhaps stabilizing. The 2-year break-even at 2.7% and 5-year break-even at 2.5% show markets projecting inflation normalization over the next 2 years. Finally, fully vaccinated levels increased over the quarter, but the vaccination rate slowed. The quarter ended with a fully vaccinated rate at 47% for the U.S. and 11% for the world. At its current pace, the U.S. is expected to reach 70% herd immunity in November 2021 and January 2023 for the world, potentially resulting in more reopening, bottlenecks, and temporary inflation. With a back down in rates and spread tightening, the AG returned 1.83% in the quarter. High yield returned 2.74%, bank loans returned 1.44%, and EMD returned 4.06%. The top chart here shows the U.S. Treasury yield curve a year ago, a quarter ago, and at the latest quarter. As we can see, while it has risen from a year ago, it is back down from a quarter ago as the vaccination rate has slowed and the Fed turns more hawkish. The bottom chart shows the steepness of the yield curve as the difference between the 10-year yield minus the 2-year yield. The yield curve has not yet inverted, which should signal that there may be more runway for the expansionary phase of the economic cycle, especially as the fully vaccinated level is only 47% for the US and 11% for the world. More vaccinations until 70% herd immunity is reached may mean more GDP growth and potential further credit spread compression. This chart shows the current Treasury yield curve as the bottom line, followed by the projected Treasury yield curve for each of the next 4 years, based on the Treasury forwards derivatives market, shown in the higher lines. With the 10-year yield ending the first half at about 1.50%, the market projects the 10-year to rise to about 2.30% over the next 4 years, or roughly 20 basis points per year. While these projections have backed down a bit from previous quarters, they continue to account for the Fed's growing hawkishness by the month. A rate hike as well as QE tapering may occur in the second half of 2021 or 2022. Higher rates may be a headwind for sovereign, corporate, and securitized issuers across the board, having borrowed large quantities at low rates over the past year. Bank loans continue to stand to benefit from rising rates with their floating rate feature, but bank loan spreads are already tighter than long-term averages, which may limit price appreciation. And we continue to monitor the bank loan market for repricings, which reduced the floating rate benefit the last time rates rose with the hikes under Yellen. Higher interest rates will be expected to cut into government, corporate, and consumer earnings and depreciate existing outstanding bonds, but will provide for greater yield and income return going forward. The left chart here shows the spreads for the major bond asset classes with their all-time widest and tightest range shown in the bars. The squares show where they are now and triangles show their long-term averages. With spreads across the board near all-time tights, bank loans and EMD are the only asset classes showing a bit more value. The right chart shows a similar view of their yields. With tight spreads, the potential for a spread widening event is growing more likely. However, not shown here, but credit fundamentals that we track on a monthly basis, such as leverage, coverage, and use of proceeds, are still benign. As the economy continues recovering, fixed income asset classes across the board may continue to produce strong returns. EMD, which has lagged behind U.S. fixed income in the recovery due to lagged vaccine access and the Delta variant resurgence, enjoys wider spreads relative to other fixed income plus sectors such as high yield. Credit fundamentals and valuations have reverted roughly back to pre-pandemic levels. Credit spreads across industries and ratings levels have already reached pre-pandemic tights, as key credit cycle barometers, given high-yield fundamentals being first to show broad market stress or frothiness, high-yield leverage and coverage are reverting back to pre-COVID norms. Shown here on the left is the median leverage as measured by debt divided by cash flow for the U.S. high-yield market. We can see that it started rising with the start of COVID in the first quarter of last year. The higher it is, the more levered and worse off high-yield issuers are. Today, it has reverted back to pre-COVID lows. On the right is the median coverage ratio as measured by cash flow divided by interest expense. It fell with the start of COVID last year, and the lower it is, the worse off high-yield issuers are because of less cash flow in order to pay interest expenses. Today, similarly, that ratio has also reverted back to pre-COVID levels. This is the case for bank loans as well. These ratios are key metrics that signify that debt issuers broadly are back to pre-COVID norms in terms of their balance sheet and earnings as it relates to their debt. Here we take a look at the key bullish and bearish cases for the major bond asset classes. For core bonds, the bullish case is that core bonds continue to provide principal protection from a potential market correction as financial asset valuations continue breaking record peaks. Core bonds will benefit from higher go-forward rates as rates rise. The bearish case is that the muted transitory rise in rates in conjunction with the economic recovery from the pandemic is expected to be a near-term headwind. For bank loans, the bullish case is that fundamentals such as leverage, coverage, use of proceeds, and defaults are all benign. Bank loan senior secured structure at the top of the issuer's capital structure enhances asset recovery and restructurings, and rising rates are expected to benefit bank loans' floating rate. The bearish case is that valuations are elevated and spreads are tighter than average but still show a little value. For high-yield bonds, the bullish case is that, similar to that for bank loans, fundamentals such as leverage, coverage, use of proceeds, and defaults are all benign. High-yield strategies are generally de-risking and tilting up in quality, being selective in beaten-up industries continuing to outperform in the rebound. The bearish case is that valuations are very elevated, with spreads very tight and approaching all-time tights. For emerging markets debt, the bullish case is that lagged access to vaccines means potential for further spread compression versus U.S. bank loans and high yield. Spreads are still attractive. The bearish case is that potential infrastructure stimulus is expected to raise U.S. rates, which may potentially tighten the yield differential between EMD and U.S. bonds, thereby offsetting the above tailwind. In the meantime, the Delta variant surge may keep EMD spreads wider for longer. We'll conclude with the final takeaways for fixed income as we head into the second half. Looking back, the 10-year declined from 1.74% to 1.45% in the quarter as the vaccination rate slowed and the Fed continues to contemplate liftoff. For now, the Fed is committed to their asset purchases and zero rates, but as unemployment levels revert back down to the normal 5% range, and if inflation were to remain elevated, we could see the Fed start to hike and taper. We're seeing a reversion of fundamentals and valuations back to pre-pandemic levels. High yield leverage and coverage are back to pre-COVID norms. Credit spreads across the board have already reached pre-pandemic tights. Inflation is soaring, but break-evens are projecting normalizing in 2 years. Looking ahead, the fully vaccinated level is now 47% for the US and 11% for the world. At the current pace, 70% herd immunity is forecasted by the end of 2021 for the US and early 2023 for the world. This may mean more inflation and spread tightening to come. We expect rates to rise over the medium term as the Fed gradually hikes on the short end and gradually unravels its balance sheet on the long end. We expect volatility and rising inflation in the short term, especially due to the base effect. But there are signs of commodity prices turning the corner. The Fed and break-evens are forecasting reverting to norms over the next 2 years. Inflation is expected to rise as the economy continues reopening. In the short term, inflation will eat into real income rates. Inflation is expected to last at least for the short term, but fixed income plus sectors such as bank loans, high yield, and EMD have historically benefited in inflationary environments. Spreads may continue to compress through all-time tights, but we expect volatility from the Delta variant surge and the Fed's hawkish signals. With spreads near all-time tights, the potential for a spread widening event is growing. Lastly, we expect the Fed and other central banks from the rest of the world to grow hawkish by the month, especially as employment figures return to norms and inflation remains elevated.
Hi, I'm Evan Frazier, and I'll be reviewing the U.S. equity section of this presentation. Larger, more growth-oriented stocks regained momentum during the second quarter of 2021 as the value and size rallies that had persisted since the fall of 2020 slightly abated. The S&P 500 index posted a return of 8.5% for the period, while the Russell 1000 growth and value indices returned 11.9% and 5.2% respectively. The Russell 2000 index, which tracks U.S. small-cap stocks, slightly trailed its large-cap counterpart, returning 4.3% during the second quarter. The June Fed meeting, which led to a drop in rates amid renewed pledges of accommodative monetary policy, as well as the spread of Delta variants of the COVID-19 virus, likely contributed to recent large-cap growth leadership. Cheaper, smaller, and more cyclical areas of the market continue to lead the way on a year-to-date basis despite recent headwinds. From a sector perspective, the second quarter saw strong performance from the information technology and communication services segments of the U.S. equity market. Interestingly, each S&P 500 sector was positive for the year-to-date period ending June 30th, and all but the utilities sector, which was slightly negative, posted a positive return in the second quarter. The energy sector, which was devastated by the COVID-19 pandemic, continues to lead the market since the beginning of 2021, returning over 40% on a year-to-date basis, though its roughly 3% weight in the S&P 500 renders its performance less meaningful than other areas of the economy for most investors. Other cyclical sectors like financials and industrials have also posted strong returns since the beginning of the year, despite cooling off slightly in June. One notable aspect of U.S. equity performance in 2021 is the extent to which earnings growth has driven returns thus far. The past 2 calendar years saw double-digit gains for the S&P 500, the vast majority of which were driven by an expanding multiple given the fact that earnings growth for the index was flat to significantly negative during those periods. This is in stark contrast to the first 6 months of 2021, which have seen the multiple on the S&P compress slightly, meaning the roughly 15% gain for the index through the end of June is in large part due to robust earnings growth by its underlying companies. The fact that earnings have contributed extensively to the index's return in recent months could indicate that market participants are becoming increasingly focused on company fundamentals, as opposed to recent years that were perhaps more speculative in nature. It would not come as a surprise to see additional multiple compression in the second half of 2021 if earnings continue to beat expectations. While core and value multiples have experienced some contraction in recent months, U.S. equity market valuations remain mostly elevated across the size and style spectrums relative to historical levels. This is certainly the case within large cap, where both value and growth stocks reflect multiples that sit at the extreme end of their respective 20-year ranges. The same can be said for the mid-cap space as a whole, as well as the Russell 2000 Growth Index. The notable outlier in this table is the small-cap value space, which appears relatively attractive from a valuation standpoint due to multiple compression in recent months. Smaller, more cyclical stocks may be poised for outsized gains in the near future, partially because of these relatively attractive multiples, as well as the fact that the space tends to perform well during periods of strong economic growth. Despite global supply chain issues and the ongoing trading of meme stocks that has pushed the prices of companies like GameStop and AMC Entertainment to extreme levels, equity market volatility remained largely muted during the second quarter of 2021. The CBOE Volatility Index, which uses S&P 500 index options to measure expected asset price fluctuations in the near term, ended the period below its 20-year average, a sign that markets have been relatively calm in recent months. Indeed, the most significant drawdown for the S&P during 2021 was roughly 4% at the end of June, far below the average for the index on a calendar year basis, which is closer to 14%. History suggests that the second half of the year may see pullbacks that are more pronounced in nature, though not necessarily indicative of systemic problems within the U.S. equity space. The equity risk premium, which represents the differential between the earnings yield on the S&P 500 and the 10-year Treasury yield, increased slightly during the second quarter as rates dropped amid renewed pledges from the Federal Reserve of accommodative monetary policy. The premium, which has been positive for roughly 2 decades now given the persistence of low interest rates, indicates the relative attractiveness of U.S. stocks compared to fixed income securities. That being said, the current premium is at one of its lowest levels since the global financial crisis and would likely compress even further given a meaningful increase in rates in the near future. While the second quarter saw renewed leadership by large cap growth stocks within the U.S. equity space, smaller and value style indices were also positive during the period and continue to lead the market on a year-to-date basis. It is reasonable to expect these spaces to continue to post positive returns given attractive relative valuations and potential tailwinds related to earnings and economic growth. Investors should be aware of the possibility of near-term pullbacks given the level of absolute valuations in the market and the fact that the biggest drawdown for the S&P 500 thus far in 2021 is less than 1/3 of the average annual pullback for the index going back 20 years. The possibility of the Fed overshooting its inflation target and ongoing supply chain and labor market dislocations could also pose challenges to certain areas of the U.S. equity space in the near term. All of that being said, the landscape appears conducive to continued positive performance from U.S. equities going forward, and we remain cautiously optimistic about the prospects of the space heading into the second half of the year.
Hi, I'm David Hernandez, and I will be covering the non-U.S. equities section. Equity markets continued their strong momentum in the second quarter, generating positive returns across the globe. Large cap developed markets and emerging market stocks were roughly equal, producing a 5.2% and 5% return respectively. This is the 5th straight positive quarter since the COVID-19 sell-off in the first quarter of last year. Over the last 12 months, the MSCI EAFE and MSCI EM benchmarks have returned 32% and 41% respectively, more than making up for the losses experienced in the first quarter of 2020. In the coming charts, we'll look at some of the 2021 trends that have emerged and provide our thoughts on what to look for in the second half of the year. And let's start by reviewing some of the top performing industries. It is well documented that the COVID-19 pandemic resulted in industry winners and losers. Internet services, healthcare, payment processing, these are examples of some of the winners for most of last year. This year, however, we've seen several of last year's losers come back with strong performance. For example, the airline industry, which lost 35% last year over the 10 months before the vaccine announcement, has returned 28% in the 7 months post the vaccine announcement. Energy, banks, and aerospace companies have also seen a similar trend. And this rebound has been a key contributor to value stocks outperforming growth stocks this year. These industries have benefited from wide valuation spreads as well as a rebound in economic activity. Several key global economies are expected to recover to pre-pandemic levels either this year or next year. These are a mix of both developed as well as emerging markets. Russia, the United States, Japan, India, and Germany are all expected to increase its real GDP per capita above the 4Q 2019 reading. China already surpassed its watermark last year. Additionally, global manufacturing and services have been expanding since late last year, with both indices reaching above 50 in August 2020 after a historic drop in April. On the services side, the Eurozone had been a lagging region relative to most of the rest of the world. However, it pushed into expansion territory in the second quarter as countries ramped up vaccination efforts and COVID restrictions were eased back. These positive developments likely bode well for value stocks since they are more economically sensitive. Given this, we think value likely has further room to run in the second half of this year, which should be a tailwind for non-U.S. developed stocks. A second potential tailwind is the increased earnings optimism we have seen since the end of last year. 2Q earnings growth estimates have increased the last 6 months for the S&P 500, the MSCI Emerging Markets, and the MSCI EAFE indices. The more cyclically sensitive EAFE index is projected to have the highest earnings growth, but all three benchmarks have seen a 40 to 50% increase in earnings expectations since the start of the year. This is a strong positive for equity investors and a welcome sign given current valuation levels. The last 2 calendar years, markets have generated positive returns and negative earnings growth. We have to go back to 2018 to identify a calendar year where we actually saw positive earnings growth occur. So the key driver of equity returns the last couple of years has been multiple expansion, and as a result, valuations are at historically high levels. Looking at 6 different valuation metrics, most of these metrics are currently in the top quartile of expensiveness compared to the last 20 years. The S&P 500 is especially expensive relative to its history. Now, these valuations are high, but they are also supported by accommodative monetary policy, including historically low interest rates. So compared to bonds, stocks do not look nearly as expensive. However, elevated multiples likely does mean lower return expectations going forward and certainly shines a bigger spotlight on earnings growth. Earnings are necessary to support current valuation levels. Fortunately for equity investors, as we covered in the previous slide, that earnings growth has delivered thus far in 2021. We will now wrap up the non-U.S. equity section with our key takeaways. Vaccine momentum and supportive monetary policy has helped economic activity exceed expectations. Value stocks, particularly some of the hardest hit industries from last year, have benefited from this rebound. Looking ahead, historically high multiples lowers the longer-term return expectations from here. While central banks remain largely supportive, we've seen some emerging economies begin to hike interest rates. We think values outperformance has room to run as economies continue to reopen, particularly in the Eurozone. And this will likely benefit the cyclically sensitive developed markets compared to emerging markets, which is top heavy in growth stocks.
My name is Jessica Noviscus, and I will be reviewing hedge funds. Hedge funds, as measured by the HFRI Composite Index, posted their 9th consecutive month of gains in June, bringing year-to-date performance to positive 10% and making the first half of 2021 the strongest start to a year since 1999. Equity hedge, or long-short equity, was a top strategy in the second quarter and the first half, up almost 13% year-to-date. Within that category, value and energy-focused strategies stood out, benefiting from the rotation we saw in the first part of this year. But fundamental growth, tech, and healthcare-focused strategies were still positive as a whole, despite being generally out of favor in the market. Event-driven strategies were another top category of funds, up 11.5% year-to-date. Distressed funds, which are typically focused on credit, particularly stand out. Those strategies as a group were up almost 15% in the first half of the year. And lastly, I want to highlight the put-right index, which is the primary benchmark for the VRP strategies that we recommend. That index was up 5.5% in the second quarter and almost 12% in the first half of the year, which is very strong capture relative to the S&P 500. While overall hedge fund performance was strong, dispersion between managers was wide. The top decile of the HFRI returned almost 39%, while the bottom decile was down nearly 7%. Hedge funds generally see pretty wide dispersion among managers. It's one of the reasons the asset class can add so much value to a portfolio. But the range this year has been exacerbated by the dynamics in the market, the impact of macro, technicals, and style factors. While there are value-oriented managers in the space, it does skew growthy, and the rotation back towards growth from value was a benefit to many funds in the second quarter. Along with performance, we saw exposure shift. Hedge funds have started moving away from the reopening and reflation trades of earlier this year back to growth. And lastly, within credit, the market opportunity set has narrowed, with yields low and spreads tight. but legacy distressed positions continue to do well, in addition to more idiosyncratic opportunities sourced by active managers. The next two slides help illustrate an increasingly favorable market dynamic for stock picking, the ratio of alpha sources to alpha takers. Alpha sources include groups like retail investors and other less sophisticated investors that create inefficiencies and alpha opportunities in markets, which we saw an extreme example of in the short squeeze in January. This chart shows retail participation in the market, increasing from around 15% in the years leading up to COVID to 24% as of Q1 21. The second part of that ratio is illustrated on this next slide, decreasing alpha takers in the market. These are fundamental hedge funds, quants, generally participants who do a better job taking advantage of inefficiencies in the market. This chart looks at average short interest, as measured by the median stock short interest as a percentage of shares outstanding in the S&P 500. The decreasing level over the last few years reflects reduced hedge fund participation. With trades then less picked over by the hedge fund community, there are more opportunities for active long-short stock pickers to create alpha. You've likely seen this slide before, but it's still very relevant today. Equity hedge funds tend to do well in periods of rising inflation and rising rates. Both of these dynamics tend to widen dispersion in the market, separating companies that can pass on inflation impacts to their customers versus those who cannot, separating high-quality companies from those who have been using easy monetary policy to disguise other issues. And this type of increased dispersion is ideal for long-short equity managers who can uniquely profit from both sides of the trade. This chart aggregates performance from past years when the Fed has raised rates, going back to the 1990s, and shows exactly that dynamic, hedge funds outperforming other asset classes. In this chart, the S&P 500 and real estate, as measured by the NCREIF price index, are a close second and third, but that could be different this cycle, with equity valuations where they are and the uncertainties in real estate post-COVID. Our last chart this quarter looks at the global M&A deal environment. We were bullish event-driven and merger arb funds coming into the year, given the expected increase in M&A deals and the resulting opportunity set for these managers. And so far we've been right. Companies are looking for growth to position themselves for a post-COVID world. Equity is valuable, and there's a lot of liquidity out there. Both strategic and financial buyers like private equity have a lot of cash. It's hard to say how long this will last, but for now we continue to be favorable on this more tactical opportunity. And we'll end with final takeaways. Looking back over the last quarter and first half of the year, we reiterate a lot of the themes we started this section with. Strong overall performance from the group, but with a number of funds struggling amid the non-fundamental dynamics in the market. Despite this, hedge fund managers remain bullish. That's evident in their above historical average gross and net exposure. And that's because, looking forward, long-short funds remain well positioned to take advantage of the rising dispersion in the market and the improving ratio of alpha sources to alpha takers. The tactical opportunity in event-driven and merger arb funds remains. And in credit, as we mentioned, despite a lack of yield and spreads that have corrected back to pre-COVID levels, managers that can source more idiosyncratic opportunities and those with expertise in less trafficked areas of the market should still find a robust opportunity set.
Hello, I am Josh Cabrera, Marquette's Senior Research Analyst of Real Estate and Infrastructure. Although real estate performance continues to be lagged on a quarterly basis, coming out of the pandemic, we are experiencing the emphasis of NOI growth rather than cap rate compression as a significant driver of absolute returns. Industrial and multifamily continue to be the major sources of outperformance within real estate, while retail and hotels have struggled the first quarter of the year amidst uncertain hopes of an eventual recovery, thereby adding to the dispersion of property returns within the asset class. Cap rates have been facing significant downward pressure across property types and have compressed to historically low levels. As inflationary fears persist across the capital markets, investors wonder whether the consequential increase in interest rates will drive cap rates to blow out across property types with limited NOI growth potential, namely in the office and retail sectors. Contrary to popular belief, as shown in the following comparison of cap rates across property types versus the 10-year Treasury rate, real estate cap rates have exhibited an ability to sustain modest increases in the 10-year Treasury rate over the past 20 years. This prevailing trend may lend credence to the belief that cap rates are not only influenced by borrowing costs in isolation, but also by the availability of capital resources, rising demand levels, and reduced supply that arise in a rising interest rate environment. The COVID-19 crisis accelerated e-commerce's share of total retail sales and skyrocketed the demand of the industrial sector. To further illustrate this trend, e-commerce requires an additional 1.25 million square footage of industrial real estate to support $1 billion of incremental e-commerce growth. This acceleration within the core real estate universe provided the industrial sector resiliency amid the recent global recession and a longer runway for growth, as opportunities for increased adoption and proliferation of online markets remained strong. As structural tailwinds of e-commerce are expected to drive the demand for modern warehouses and industrial assets, a rapidly progressing economic reopening should support both end-user consumption and trade activity in the near term. Against a backdrop of extended office closures across the U.S., uncertainty lingers in the office sector as vacancies have increased and net absorption further declined during the first quarter of this year. The recent rate of deterioration within office fundamentals has been somewhat surprising, given the recent rebound in the labor market as the economy reopens. Although office rents have been sticky thus far, questions remain about the longer-term demand for office space as property owners have been compelled to offer leasing concessions in primary markets hit hardest by increased vacancy rates. Furthermore, the shift to a remote work environment has prompted the reevaluation of office demand, as the average days in the office has fell from 4.6 days a week to 3.6 days a week. Flexible work strategies may continue the reduction in office. However, the practical realities of increased workplace collaboration and productivity may counteract the reduction in office demand. With the vaccine rollout in full swing, office demand is expected to stabilize in the second half of the year as more and more employees return to work, setting the stage for an uptick in leasing activity in 2022. However, rising new supply combined with more than a year of minimal leasing activity will continue to put downward pressure on office rents and occupancies in the near term. Despite the tumultuous pandemic-stricken backdrop and multiple headwinds prompting the adaptation of retailers across all store and restaurant formats, the retail sector has shown resiliency in a distressed environment. As vaccination expands further and the economy continues to transition to a newer normal, the retail recovery is expected to be uneven, varying by market and time horizon over the next few quarters. However, reasons for optimism persist, as consumer spending has bolstered leasing activity in recent months, which, despite being below pre-pandemic levels, has improved noticeably. As economic activity expands from the reopening, pent-up consumer demand is expected to drive up activity to local retail centers. Predisposed shopping behavior will remain as consumers utilize the omni-channel methods they became accustomed to during the pandemic. However, as the latest retail sales growth data suggests, spending patterns already are shifting from essentials to discretionary goods and services, including restaurants. Both trends point to a recovery in foot traffic and sales activity at neighborhood and community centers in the near term, and longer term to a role for well-located retail centers leveraging omni-channel retail strategies to reach evolving consumer spending habits. In summary, looking back, pricing by property subtypes during the COVID-19 pandemic exhibited a significant degree of variance, with apartments and industrial faring much better than its core real estate counterparts. In addition, the industrial sector maintained its torrid pace over the course of the past year, fueled not only by the demand from tenants, investors, and a wide opportunity set of favorable financing, but also by the wave of e-commerce penetration. Furthermore, densely populated CBDs and primary markets with high levels of new supply face stronger downward pressure on rents as flexible work schedules and tenant leasing concessions redefined office fundamentals. Finally, as the long-term prospects of commercial real estate came into question, investors started to direct a significant amount of deal flow and dry powder to relatively more attractive alternative sectors. Looking ahead, as the economy reopens and the vaccination campaign becomes more widespread, office and retail uncertainties are expected to become less blurred over the long term. As workers adapt to returning to the office in the back half of the year, flexible work-from-home structures may not be sustainable in the long term. Moreover, the retail sector is expected to benefit from increased foot traffic and activity. In addition, cap rates across all property types may see an increase in direct correlation with rising Treasury yield proxies. This high interest rate environment should continue to shift the focus to NOI growth as the main driver of absolute returns, as well as widening the gap of performance dispersion among property subtypes. Furthermore, as the relative attractiveness of alternative sectors becomes more pronounced, investors should continue to deploy available capital resources in the life sciences, data centers, and medical offices to meet long-term return objectives. Finally, rising inflationary fears should increase the demand for apartments, which have the benefits of shorter leasing terms to counteract the effects of rising costs of labor and raw materials. And now moving on to infrastructure. While performance continues to be lagged on a quarterly basis, coming out of the economic shock of the pandemic, infrastructure returns exhibited a noticeable rebound at the end of 2020, as the defensive cash-yielding attributes of the asset class became more appealing to institutional investors searching for stable income sources and a reliable inflation hedge. While infrastructure fundraising slowed over the past 12 months, the asset class has experienced consistent and reliable fundraising levels for the past several years. As institutional investors seek longer-term contracted cash flows and a lower correlation to GDP risk factors, more significant fundraises are expected to take place in the coming quarters. Over a period of relatively low interest rates and larger scale asset purchases, infrastructure core valuations have been pushed disproportionately higher as investors pivot away from higher volatility fixed income alternatives. The appetite for longer duration infrastructure investments has been amplified by a flattening yield curve. As investors search for stable cash yields, portfolio diversification, and inflation hedging vehicles to manage overall risk and reach return objectives. In summary, looking back. Although the COVID crisis may have negatively impacted deal flow, transaction levels, and capital fundraising, institutional investors were less impacted due to the defensive makeup of their infrastructure exposures. In addition, as of the first quarter of this year, private infrastructure experienced a yearly increase in capital flows as the majority of dry powder was allocated to the larger colossal funds. Finally, COVID-19 restrictions highlighted which infrastructure assets were more vulnerable to GDP risk factors. Travel restrictions, which persisted in many parts of the world, have caused air and road traffic to recover more slowly, with neither yet recovering to pre-pandemic levels. Looking ahead, increased demand for telecommunications and renewable energy assets will create an expanded opportunity set for closed-end funds. However, these niche infrastructure alternatives must justify their liquidity lockup with superior risk-adjusted returns to increase demand across the investment universe. In addition, if Joe Biden's $1.2 trillion infrastructure plan is approved, deal flow should positively impact both public and private sectors, with pipelines to clean energy and telecommunication exposures. Furthermore, rising inflationary fears and the prevailing investor need for cash yield should only increase the demand for infrastructure investments. Finally, fundraising is expected to recover to pre-pandemic levels in 2021, as short-term inflationary concerns should drive investor interest into core and core plus strategies.
Hi, I'm Derek Schmidt, Marquette's Director of Private Equity, and I'll be covering the private equity section. While returns are still lagged, 3Q and 4Q performance rebounded strongly within private equity, providing strong absolute and relative performance against public markets as the economy reopened. Here we can see the mid-teens returns provided within the third quarter, with numbers further improving in the fourth quarter. Growth-focused investments continue to do well, as the venture capital market has provided the strongest performance over the past year, with the fourth quarter providing further strong returns due to a robust exit and IPO market. Within private equity, fundraising slowed for the year, primarily due to the severe slowdown in the first half due to COVID and the lack of travel.
However, fundraising returned to pre-COVID levels in the fourth quarter, and 2021 is off to a very strong start, as many closes were pushed to 2021, and many emerging managers re-emerged in front of investors with the opportunity to once again raise their funds. From a fundraising perspective, 2021 was challenging for both really large and small funds to raise capital. While many emerging managers and very large funds pushed their fundraises to 2021, it was primarily the middle market funds with strong established LP bases that were able to raise capital in 2020. We continue to see an attractive opportunity for allocations into smaller funds where fundraising has been less significant, with opportunities then to sell businesses up market into well-funded larger funds looking for attractive investment opportunities. Deployment picked up significantly in the second half of 2020, but similar to fundraising, declined overall relative to 2019, as managers were cautious given the market uncertainty and priced in considerable risk. 2021 again is off to a very strong start from a deployment perspective and should rebound to meet or exceed 2019 deployment levels. The growing disconnect between public and private market valuations remains large, reflecting a 52% discount in private market transactions. We continue to believe the most attractive area of the private equity market is with small funds focused on taking advantage of the persistent inefficiencies of investing in small companies. While the private equity market slowed down in many ways in 2020 relative to 2019, we have seen activity pick up quickly in 2021, returning to pre-COVID levels. We continue to see an attractive relative opportunity within private markets compared to public markets, and many investors are taking advantage of vehicles with accelerated or seasoned deployment. We expect a strong deployment year for private equity in 2021 as dry powder remains significant. Competition at the upper end of the middle market remains intense, providing a structural dynamic that should continue to benefit the smaller and earlier stages of the buyout and venture capital market. Finally, we continue to see strong investor interest in private markets, which is increasingly attracting traditional asset managers to either launch private market funds or acquire private market firms. We see this trend continuing due to the long-term view of what is likely to be continued investor interest in private markets.
Hello, I'm Brett Graffey, Senior Research Analyst at Marquette, and today I'll be discussing the second quarter private credit market environment. Reporting on a lag basis, private credit finished strong in the fourth quarter of 2020, up over 5%, exceeding the Credit Suisse Levered Loan Index and the Barclays Agg. In its tumultuous year, private credit produced positive returns up 2%, but lagging most public indices. Alternatively, over the 10-year time horizon, private credit has produced strong returns, exceeding public fixed income indices, but lagging the equity markets. Overall, the structure and yield premium achieved by investing in private credit remains as a return driver and a risk mitigant for the asset class. Overall, in 2020, private credit assets under management increased marginally, while dry powder fell slightly. As noted in the earlier slides, due to the decrease in fundraising, residual cash held by managers waiting to be invested in new opportunities fell to its lowest level since 2017, in which lies the opportunity for many investors. Private credit capital remains in high demand from counterparties such as private equity sponsors and individual companies as these borrowers look to finance new acquisitions or finance existing debt at lower rates, providing private credit managers with increased deal flow and attractive investment opportunities. Private credit is still providing investors with yield and structure premiums relative to traditional fixed income asset classes. Currently, high yield bonds are yielding approximately 3.6%, and the Barclays Agg is yielding right around 1.4%. Investors have to go all the way down on the rating scale to CCC rated bonds to find a comparable yield to private credit, which is yielding 5.4%, which remains well below private credit yields. Furthermore, CCC rated bonds are not only lower in quality to most private credit, but they are also subordinate in the debt capital structure to private credit loans. Driven by low interest rates and lower return expectations across various asset classes, private credit continues to garner investor attention as the search for yield remains front and center. Overall, since a year ago, private credit performance has bounced back and performed well, much in line with how it has performed over the past decade. And while fundraising plateaued in 2019 and fell substantially in 2020, we see early signs that 2021 fundraising totals will be strong and could eclipse previous highs. Most importantly, the asset class continues to prove itself as a value add to institutional portfolios. The need for private credit remains strong as companies, both private equity backed and non-private equity backed, are in need of capital to finance new acquisitions or to refinance existing debt at a lower cost, all against the backdrop of the lack of bank participation in the market. Being top of the capital structure and earning a yield above traditional fixed income remains a key selling point for current and prospective investors. While these factors will continue to drive the asset class and attract new capital and new market entrants, we believe the fundamentals will remain intact, and we see many benefits for investors to include private credit alongside their existing fixed income and equity portfolios.
We'd like to thank you for watching this video. We hope it helps you and your committees plan for the remainder of the year and give you some themes to watch for as markets play out for the rest of 2021. If you are a Marquette client and have questions about any of the content on today's video, please feel free to ask your consultant for more information. Alternatively, you can send us an email. For specific inquiries, please use the first email address listed on this page, research5@marquetteassociates.com. For general Marquette-related inquiries, use the second email address, marquettemarketing@marquetteassociates.com. In terms of next steps, if you have any feedback, please share it with us. We want to maximize the utility of these videos for you, our listener. So if there are suggestions you would like to see, please let us know. You can subscribe to our channel for quarterly market insights videos. You can also register for research email alerts on our website using the address listed below. We will see you next time, and thank you again for spending some time with us today.